Look, nobody likes a financial mystery, especially one involving a company selling a ton of electric cars, but still watching its stock plummet. Welcome to the curious case of NIO, the Chinese electric vehicle maker that can't seem to catch a break. Despite delivering a record number of vehicles, their stock price has taken a nosedive. How can a company firing on all cylinders be stuck in reverse on the stock market? Is it irrational market jitters or deeper issues driving this divergence? Buckle up because we're diving into NIO's world where sales are up, stock is down, and uncertainty reigns. Let's start with the good news, shall we? Because for NIO, it's actually pretty impressive. As of July 2024, the company has sold over 107,000 vehicles, a figure that would make any car maker proud, especially one operating in the increasingly crowded electric vehicle market. This impressive sales performance, however, only makes the dismal performance of NIO's stock even more perplexing. Imagine running a marathon, setting a personal best time, only to be told you finished last because, well, reasons. That's essentially the situation NIO finds itself in. They're selling cars hand over fist, but their stock price is down nearly 59% for the year. It's the kind of disconnect that would make even the most seasoned Wall Street analyst reach for the Pepto-Bismol. So what gives? Why is the market seemingly ignoring NIO's impressive delivery numbers? The answer, like most things in the world of finance, is complicated, involving a perfect storm of factors, from increased competition and shrinking profit margins to a slowing Chinese economy and geopolitical trade tensions. It's enough to make you want to ditch the electric car and invest in a good pair of walking shoes. Remember that impressive delivery figure we mentioned earlier? Well, it seems that even a record number of cars sold can't completely mask some underlying financial concerns. NIO's first quarter results for 2024 were, to put it mildly, underwhelming, posting a loss of 36 cents per share. This unexpected dip in profitability sent shockwaves through the market, causing investors to hit the panic button and dump their NIO stock like it was a used napkin from a particularly messy burger. While a single quarter's performance doesn't necessarily spell doom and gloom, it did raise serious questions about NIO's ability to translate its impressive sales growth into sustainable profits. Investors, being the skittish creatures they are, tend to react poorly to any whiff of uncertainty, especially in a volatile market where countless other shiny, potentially profitable objects are vying for their attention. The weaker-than-expected Q1 performance served as a stark reminder that selling a lot of cars is only half the battle in the cutthroat world of automotive manufacturing. To truly thrive, NIO needs to demonstrate its ability to control costs, improve margins, and convince investors that its long-term profitability prospects are brighter than a Tesla showroom lit entirely by Edison bulbs. Speaking of Tesla, let's talk about the elephant in the room. Or rather, the electric car company with a market capitalization larger than the GDP of some small countries. Tesla, under the, shall we say, unconventional leadership of Elon Musk, has been waging a full-blown price war in the electric vehicle market, slashing prices with the ruthlessness of a honey badger defending its burrow. This aggressive pricing strategy has sent shockwaves through the industry, forcing competitors like NIO to either match Tesla's discounts or risk losing market share to the electric vehicle behemoth. It's a classic case of damned if you do, damned if you don't, as lowering prices eats into already thin profit margins, while maintaining higher prices could alienate cost-conscious consumers. This price war has created a particularly challenging environment for companies like NIO, which are still trying to establish a foothold in the rapidly evolving electric vehicle market. While Tesla has the luxury of sacrificing short-term profitability for long-term market dominance, smaller players like NIO don't have that same flexibility. It's a high-stakes game of chicken, and right now, Tesla seems to be holding most of the cards. Section 5, the shrinking sticker price. A margin squeeze for NIO. Adding further fuel to the fire is the fact that NIO's average selling price has declined by about 6% compared to last year. This drop, while seemingly insignificant at first glance, has significant implications for the company's bottom line, especially when combined with the aforementioned price pressure from Tesla. It's like trying to bake a cake with less sugar and expecting it to be just as sweet. It just doesn't add up. This decline in average selling price is partly due to NIO's strategic decision to introduce more affordable models to appeal to a wider customer base. While this move makes sense from a market share perspective, it also puts downward pressure on profit margins. making it even more challenging for NIO to achieve the kind of profitability that investors crave. It's a delicate balancing act, and one that NIO has yet to fully master. They need to find a way to offer competitively priced vehicles without sacrificing the premium features and brand image that initially attracted customers to their brand. It's a tightrope walk, and one wrong step could send them tumbling into a chasm of financial uncertainty. Section 6. Revenue versus deliveries. A tale of two growth rates. While NIO's unit sales have soared, their revenue growth hasn't kept pace. This disparity signals potential trouble for investors. NIO expects revenue growth, but slower than their car sales. They're moving units, but not at the most profitable price point. NIO needs to focus on selling cars more strategically. Section 7. China's economic engine stalls, a red light for automakers. As if the challenges of a price war and shrinking profit margins weren't enough, NIO also has to contend with the headwinds of a slowing Chinese economy. China, once the engine of global economic growth, has hit a bit of a speed bump with reduced consumer spending and domestic consumption impacting a wide range of industries, including the automotive sector. It's like trying to sell ice cream during a blizzard. Sure, some people might still buy it, but it's not exactly the ideal market conditions. This economic slowdown has led to reduced demand for automobiles, making it even more difficult for companies like NIO to sell their cars. It's a classic case of bad timing, as NIO is attempting to ramp up production and expand its market share, just as the overall market for cars is contracting. The Chinese government, in an attempt to revive the flagging economy, has introduced various stimulus measures, but their effectiveness remains to be seen. Until consumer confidence returns and the Chinese economy regains its mojo, NIO and other automakers will likely face continued challenges in the world's largest car market. Section 8. Trade barriers, a roadblock to global domination. Expanding beyond its home market is crucial for any ambitious automaker, and NIO is no exception. However, their plans for global domination have hit a significant roadblock in the form of increased trade barriers. The US's 100% import duty on Chinese electric vehicles has made it significantly more expensive for NIO to sell in the US market. This trade war has created a lose-lose situation for everyone involved. Chinese automakers are shut out of the US market, while American consumers miss out on innovative and affordable electric vehicles. These trade barriers have forced NIO to reevaluate its global expansion plans. Section 9. A history of underperformance, NIO versus the market. To fully appreciate the depths of NIO's current predicament, it's important to consider their historical stock performance, which, to put it mildly, has been less than stellar. Over the past 3 years, NIO's stock has consistently underperformed the broader market, lagging behind the S&P 500 by a significant margin. It's like showing up to a track meet in a clown car and expecting to compete with Usain Bolt. It's not going to be pretty. This history of underperformance has made investors understandably wary of NIO, casting a long shadow over their future prospects. Even the most bullish analysts would be hard-pressed to argue that NIO is a low-risk, high-reward investment, especially given the multitude of challenges they currently face. This lackluster track record, combined with the ongoing economic uncertainties and geopolitical tensions, has created a perfect storm of negativity surrounding NIO, making it difficult for them to attract new investors or convince existing ones to stick around. Section 10. The road ahead. Bumps, detours, and glimmering opportunities. So, after that roller coaster ride through NIO's financial woes, you're probably wondering, is there any hope for this beleaguered electric car maker? The short answer is, it's complicated. The long answer is, maybe, but it's going to be a bumpy ride. Despite the challenges, some potential bright spots could offer a glimmer of hope for NIO's future. The Chinese government, recognizing the strategic importance of the electric vehicle industry, has introduced new incentives aimed at boosting sales and supporting domestic manufacturers. These incentives, which include tax breaks and subsidies, could provide a much-needed boost to NIO's bottom line and help them weather the current economic storm. Furthermore, NIO's entry into the lower-end EV market with its new Onvo L60 model could open up a new segment of price-conscious consumers, potentially driving significant sales growth. If NIO can successfully navigate the challenges of competing in this crowded and price-sensitive market, it could provide a significant boost to their overall market share